I'll be coming down.
All right. Welcome back, everybody. This is Thursday, February 22nd, 10:15 a.m. And today, I told you, I promised you I was going to have Scott back and talk. Scott Hill is back to talk about what's going on in the market and a new loan product that he is in love with. Scott, how you doing? He's in the Altamont Pass right now, so it's perfect timing,
Can you hear
Scott.
me? Yeah, we'll
No,
we'll
you're
uh we'll, we'll be coming out soon here.
okay. So why don't I talk until you stop getting jittery, and then we can just really quickly go what's up on my chart. And Scott, I hadn't shown this to you. I want to show this to you to the viewers real quick. What's going on? Uh, this is why the market is doing what it's doing. Real estate is still selling, not at the same peak, the same velocity, but houses are still selling. We're still far below a 30, 40-year average of interest rates. The average from 1972 to 2022 is 7.76, and today we're seeing rates around 5.5%. Scott, is that right?
Yeah, in some cases, depending on credit score, down payment, and points, we're definitely into the mid to
Yeah,
lower fives, which is awesome.
yeah. And in January 2023, it was on average of 6.25, 6.27. But today we saw the rates. I mean, the Fed's talked about the quarter BIP or 25 BIP increase to further slow down inflation. You look at the stock market, you look at the rates. The rates already know they adjusted a couple days ago, knowing that this is a possibility. And today we have rates way down below, like you can get below 5% with the point, right?
Yeah, you can, and then 15 years, of course, even a little lower than that.
Yeah.
And you made a huge point there in regards to hey, what the Fed just raised a quarter. Why are mortgage rates dropping? And this goes back to the old this stuff gets kicked in or baked in, if you will, ahead of time, right? Okay, we know they're going to raise in a couple of weeks, a quarter, and then all of a sudden it happens. It's ho hum. So the mortgage bonds already knew what was going on, and this is proof right there that mortgage rates can come down even though the Fed rate goes up.
It's crazy, right?
Yeah,
But I
yeah,
mean, we've been doing this long enough. The market knows what's going on. They
yeah,
can assume what's going on. Maybe like in the beginning when they started doing the 0.75 increases, that was kind of a shock to the system because we're used to free money for so long.
right.
But that wasn't healthy, right?
No,
It wasn't healthy. It bolstered a lot of things. That's why we have inventory shortages all across the world for everything from chips to eggs to toilet paper to cars, right? So,
absolutely.
all right, Scott, the reason why we talked earlier last week, you wanted to talk about a new loan idea, and I'm excited to hear more about it. And can you hear me?
I think I lost you a little there,
Yeah.
Vito. Can you? Yeah, go ahead. Try that again.
We've been talking,
I'm
you
at
and I have
the.
been talking for the
By the
last
way,
couple.
I'm at the bottom of the ultimate.
Is that good or bad?
We're good.
Okay, good. So you've been talking about this new loan product that's out there.
Yeah,
Want to learn a little bit more about it. I'm excited to hear about it. I didn't ask you too many questions, but I want to see what
yeah.
this is good for our consumer friends out there.
You got it. This is a kind of a product that I think a lot of people are not aware of, and it does exist. That is really, really going to help a lot of borrowers that fit this particular niche, if you will. I'm going to read the loan program mission to you and try to not crash here. But I want to get it word for word. The loan program mission is empowering the dreams of diverse homeowners in underserved communities by providing non-traditional access to prime capital for underbanked borrowers and communities. So that's the mission of the product. But don't let that fool you, because it is actually a product that's open to everyone, okay? And I have used this product quite a few times already for clients very, very effectively. And let me tell you, in order to lend on this product, the institution that does the loan has to be what's called CDFI certified. They have to have a CDFI certification, which stands for Community Development Financial Institution. And that gets around the ATR, the ability to repay, situation that we have to follow as lenders to make sure we're not putting clients into loans that they can't afford. So one of the ways they're going to look at this is they're going to look at, the down payment's got to be strong, first of all. The credit score has to be reasonable. It doesn't have to be perfect. The client has to show the ability to have money in the bank left over, which we in the lending world call reserves, right? Take the monthly payment, multiply that times, 12 months, 18 months, whatever that may be. If they can show that, then they can qualify for this program. So let me give you a case study or two that's perfect for this product. Case study one, I had a client a number of months back. She was a teacher making a modest income. The father had just got out of a stressful job and wanted to take time off with the new baby, and they were going to be living only on the wife's income. And they had just inherited about $1.5 million from a family member that had passed away. So essentially, they found a wonderful home they wanted to buy in Livermore. They actually, believe it or not, had 2 other rental properties that they were generating income on, but they were not reporting it on their taxes. So I could not use that as income. So all I had was the teacher salary. So this product was perfect. They had the 12 months reserves we needed. They had the 20% down we needed, and they had the credit score. At the time, the credit score was 700 for 20% down. They have since upped that to 720 and just tightened it a little bit. Fast forward a month or two, they're in a beautiful home. They've got, they put I think they put 30% down actually. They still had $1 million to live off of in addition to her salary. So it was a perfect situation where otherwise they wouldn't have been able to buy a home. The second scenario that we just closed, we're about to close on it right now. And this is a situation where a mom whose husband just passed away has a 25-year-old daughter that works at Hallmark. Okay, so she doesn't have a really huge income, but they had to sell their home. The husband passed away. The mom couldn't afford to make the payments anymore. She wasn't working. So the daughter and the mom said, well, why don't we buy a home together? I don't have a salary, but my daughter does, thinking that they might be able to afford something. Well, traditional financing was not going to solve the problem because the income was not high enough for the daughter, but the down payment was there. So we got them into contract here just recently. I think it's down in Gilroy on a beautiful home. The mom's going to be able to move in, and the mom is going to be getting a job again, but she's not ready for the job right now. So they're going to put down $450,000. They'll have $100,000 left over. There is no income to debt ratio qualifying. So typically this would not work. The other scenario I mentioned would not work. So you can see this fits a niche for people that have money, have the ability to make the payment, but can't prove it, or will be using the cash they have in the bank to allow them to comfortably live with a mortgage payment.
That's awesome. So this is really, like, I was just imagining you can use it for small business owners, people that don't necessarily, report all income type of thing, right? Where they have money in the bank, mattress money. Now, do they have to show where that money has been sitting for a couple months?
Usually they usually require about a month in the bank, and this does work for what you're talking about. And let me just kind of pivot off of that for a second. So notice neither of these people were self-employed, but they had income and they had cash. I would probably use a bank statement program or a 1099 program as my first option for someone like that. And the reason I would is because the interest rates are going to be a little bit better than the program I'm mentioning. So the program I'm mentioning, you're going to be paying probably at least 2.5% higher minimum for this product. And it's because there is total risk for the lender to not do any income qualifying. I mean, we don't even put any job information on the application. That's how barren it is. So if we're going to do maybe a self-employed person that has a lot of deposits, has 1099s, but maybe they just write off a lot and
Right.
we can't use the tax returns, then I'll use a non-QM product for them, and that's going to save them some money. They really don't need this product, okay?
Got it. I understand now. Okay. So this one right here, you said 2.5% hit on the interest rate. So if it's 6%, you're looking at like 8%, but you're getting them into a house.
Yeah, and there's a couple. There's a couple tiers. So if you have 20% down, just let's talk about that. 12 months reserves, 720 FICO score minimum. If you can put 25% down, 700 FICO score minimum, 12 months reserves. If you can put 30% down, you can get away with 680 FICO score. And condos must have 25% down.
Okay. Yeah.
All right. And one other thing. If you put 25% or more down, you can set this up as an interest-only payment, not on the 20% down.
Oh, I see. Yeah, that's
so you
running
can get a little
against.
bit more flexible with cash flow.
It makes it a lot more affordable when you're using interest only. You're just not putting away in principal, right? So that's the one thing you have to realize. But you're getting into a house. Yeah,
absolutely. And I always recommend it as a feature for in time of need, not to live that way. And
right.
I have a deep conversation with clients that use interest only, that it's a tactical reason, not a survival reason.
I see. That is really awesome. Well, that's just great. And when people need to learn more about this, they can give you a call. Do I have your? I don't think I have your.
Sure. Yeah, I'll give it to you right now. You can post it if you want. You can call me direct on my mobile if you want to learn a little bit more about it at 408-898-0100. You can go to my website, which is Hill Mortgage Inc. That's INC, hillmortgageinc.com, and email me at scott@hillmortgageinc.com.
I misspelt your Hill. Apparently, you have to put two L's in there.
I hope it's the L that you had the problem with and not the vowel.
That's funny. Okay, I'm doing it right now. I lost you. Uh-oh. There you go. Well, you're back.
Still there?
All right. 408-898-0100, hillmortgageinc.com. Is that right? Does that sound right? We're going to pretend that's right. You can't hear me, Scott.
Vito,
Scott,
can you hear me?
I can hear you. You can't hear me, though, for some reason. So we're going to call it a cap. We're at 15 minutes. Scott, thanks a lot for your time today. And Vito Scarnecchia, Abitano Group. We'll see you out there.